All right, so Lucky Strike Entertainment just dropped their earnings, and boy, are they making a massive bet. We're talking about a huge shift away from just bowling to becoming a giant and location-based fund. But despite some pretty good news on the surface, the market seems, well, skeptical. Let's dig in and figure out why.
And this really is the central puzzle of their Q4 2025 report. I mean, look, revenue came in strong, better than all the analysts were expecting. But if you were watching the stock, you saw it pop before the market opened, and then it just slid all day, closing in the red. So what's the deal? What did the market see that just completely soured the mood?
And this slide right here shows you the conflict in plain black and white. Over on the left, a really solid revenue beat. We're talking maybe $7 million better than expected. But then you look to the right, a huge miss on the bottom line. The GAAP earnings per share came in at a loss of 52 cents. That missed the estimate by a whopping 42 cents. Now that is the kind of number that gives investors serious pause, and it's really the heart of the market's whole reaction.
So let's unpack these mixed results, right? We're going to really dive into the key metrics to understand exactly what was driving that cautious feeling on the street.
You know, what's really interesting here is the story this table tells. The top line looks great. Revenue is up over 6% from last year, which is fantastic. Adjusted EBITDA, that also grew, another good sign for how the business is operating. But then you get to the bottom of the table. That EPS miss we just talked about is the big blinking red light. And right below it, same-store sales. That's the money from their existing spots. It actually went down by 4.1%. A decline in the core business, that's a major headwind.
But despite those headwinds, you gotta hand it to management. They are not playing small. Not at all. They laid out this incredibly ambitious vision, a playbook that's designed to turn Lucky Strike into a full-blown location-based entertainment empire.
And hey, don't just take my word for it. The CEO, Thomas Shannon, said it himself. He sees the company becoming a mini Disney. His argument is that as Disney goes all in on its theme parks, Lucky Strike is doing the exact same thing in their own space, and he thinks the market just doesn't get how big this opportunity really is. That's a bold comparison for sure. High stakes. And they are moving incredibly fast. This is not just talk. Over the summer, they went out and bought the actual land under dozens of their locations for over $300 million. That gives them way more stability and control. And then they snapped up 2 massive water parks and 3 family fun centers. All this spending, by the way, is a huge reason for that earnings miss we saw. They're basically sacrificing short-term profits to pour fuel on this long-term vision.
So how are they going to make all these new places work? Well, management laid out a pretty clear, repeatable 4-step playbook. Step 1, find assets that have been a bit neglected. Step 2, fix them up. Step 3, make the food and beverage offerings, which are high margin, way better. And finally, Step 4, ramp up marketing to get people in the door. It's the exact same strategy they used with bowling, and now they're just applying it to this new, bigger universe.
Okay, so we've seen the high-level numbers. We've heard the grand vision. Now it's time to roll up our sleeves and dig into the operational details to see what's actually working and maybe what isn't, under the hood. First up, a huge bright spot. Their season pass program. I mean, wow! Revenue from these passes jumped from $8.5 million to over $13 million in just 1 year. And this is more than just the money up front. Management calls this program a data flywheel. It drives repeat visits and gives them tons of chances to upsell to this really loyal customer base of over 260,000 members. That's a big deal.
But, and you knew there was a but coming, right? Here's the other side of the coin, that 4.1% drop in same-store sales. This is the core challenge. You just can't acquire your way to growth forever. Your existing business has to pull its weight. Now, management was quick to say that things got better every single month of the quarter and actually turned positive in July. But it's for sure a metric we've got to watch like a hawk.
So where is this weakness coming from? Well, a massive piece of the puzzle is California. The state makes up about 20% of their total sales. And on the earnings call, the CFO pointed out that a full $6 million of that same-store sales decline came from just that one state. That is a ton of risk concentrated in a single market.
Drilling down even deeper, the food and beverage story is also a mixed bag. Their focus on food, it's paying off. Comps are up 2.5%, which is great, but alcohol sales, those are down almost 3%. Management acknowledged that, societally, people are drinking a bit less, and they're being smart about it. They're pivoting and leaning into cool non-alcoholic drinks, like their new craft lemonades, which are already on track to do $5 million a year.
All right, so that was the look back. Now let's turn to the future.
What is management telling us to expect for the next fiscal year?
So here it is, the official guidance for fiscal 2026. They're projecting total revenue to grow somewhere between 5 and 9%, landing between $1.26 and $1.31 billion. They're also expecting adjusted EBITDA to be in the range of $375 to $415 million. These are solid growth numbers for sure, but hitting them is going to require a whole lot of things to go just right.
And speaking of things going right, hitting that guidance really depends on these 4 key factors. 1, they have to successfully bring those new, complex water parks into the fold. 2, they need that planned $10 to $15 million marketing boost to actually work. 3, they absolutely have to turn those negative same-store sales positive. And 4, they need their corporate events business, which has been pretty weak, to bounce back. That's a tall order. So, let's put it all together. What's our take heading into the next earnings call? We've looked at the numbers, we've heard the strategy, and we've seen the guidance. Now, it's time for the verdict. You can really break it down into a classic bull versus bear case. The bulls are saying, look, if this mini Disney thing actually works, the potential market is enormous. They've got a proven winner with the season pass, and owning their real estate adds stability. The bears, on the other hand, they're going to point to that massive earnings miss and say there are profitability issues. They'll highlight the negative same-store sales, the huge execution risk with these new acquisitions, and the ongoing weakness in places like California. So, given this balance, this huge opportunity on one side and some very real execution risk on the other, our rating is market perform. The ambition is exciting, it really is. But the challenges in the core business and the sheer complexity of these new acquisitions, it stops us from being more bullish, at least for now. We need to see them prove this playbook can work outside of just bowling. Now for our trade idea. We're suggesting a pairs trade. The idea is to go long on Lucky Strike stock, while at the same time shorting a broad leisure ETF, something like PEJ. The rationale here is simple. This isn't a bet on the whole economy or on people spending money on fun. It's a very specific bet on Lucky Strike's management and their unique strategy. If they can actually pull off this mini Disney consolidation, they should dramatically outperform their peers. This trade is designed to capture that potential outperformance while protecting you against the whole sector taking a hit. So that's our analysis. Lucky Strike is at a really fascinating crossroads. The big question for next quarter is simple. Can they execute this grand mini Disney vision, or the cracks in their core business start to threaten the whole empire? And as always, this is not financial advice.